Hello friend. Hello friends. Today we are going to discuss about the topic on working capital. This is a part 4. This is related to working capital finance or sources of working capital finance. Financing working capital or sources of working capital finance. So basically in the uh, previous first classes we had talked about the uh, types of working capital concept. There are two types of working capital concept was there. The first working capital concept is gross, that is the gross working capital and net working capital. The second one is the working capital concept is classified on the basis of um, that variability, that is a fixed working capital and a temporary working capital. So on that basis, so we are going to discuss about the sources of working capital finance. Okay, so that is the types of working capital is there. That is two types. There is uh, fixed or permanent working capital, and second one is your temporary working capital. Okay. So on that basis of classification, the working capital finance, the sources of working capital finance is also based on these two types, that is fixed working capital and temporary working capital. That means fixed working capital is generally financed by permanent sources or fixed sources or fixed source, and temporary working capital is generally financed from short-term sources, short-term or temporary sources or variable sources. Sources of working capital finance. So that means the total working capital of the business is to be financed through two sources. Mostly that working capital, as working capital is divided into two parts, that is fixed working capital and temporary working capital. So on that basis, the fixed part of working capital is financed from the permanent sources or fixed sources, whereas temporary sources of working capital is financed from variable sources or short-term sources. This is a long-term source of working capital finance, and this is the permanent sources of working capital finance. So as per practice, the different business firms uses the different source of working capital finance. So the fixed part of working capital finance constitutes around 20 to 25%, whereas the temporary working capital constitutes about 80 to 75%. That means the total working capital, temporary working capital is 80 to 75%, and fixed part of working capital constitutes only 20 to 25%. So since it is a very uh, That means 1/4 part of the total working capital. So it is generally financed for permanent sources of the business, or the fixed sources or long-term sources of the business finance. And this 80 to 75% which constitutes that is uh, uh, that is your 3/4 percentage, 3/4 part of the working capital is financed from short-term or the temporary or the normal operating sources. So come to the fixed sources of working capital. Fixed sources of or the permanent sources of working capital is divided into two types, that is internal sources and external sources. Mostly that is the internal sources of fixed or the permanent working capital is, that is first is your retained earnings, then reserves and surplus of the business. So these are the two important sources, internal sources of permanent or the fixed working capital finance. Whereas external sources constitutes your shares, issue of shares, second is your debentures, third long term loans. So these are the mainly three important sources, from external sources from which working capital, fixed part of working capital is financed. Let's to discuss first one, that is the permanent or sources or the fixed sources of working capital is mostly financed. Internal sources is retained earnings. So that is a zero cost source of funds. It is the own sources or the profits which is generated by the business and reused in the business for working capital finances purposes. And it is a retained earnings, also otherwise known as plowing back of profits, because again it is the profits is reused and invested in the business for the operating of the business, running the operating part of the business. Then the second sources is reserve surplus. Reserve surplus is another constituent important part of the fixed source of working capital finance. It is also internal or the internal sources of funds generated and reserved accumulated profits since the previous years, and this accumulated profits is called the reserves and surpluses, and it is used when working capital is required for the business. So these are the two important sources of working capital finance. Then come to the external users sources of fixed working capital finance or the permanent source of working capital finance. The first one is your issue of shares. Issue of shares is two types. There is a equity shares and the preference shares. The first part, that is the equity shares, that is the owner's shares, owner's equity. Owners invested money in the business through the shares, issue of shares. The shareholders which money is invested in the business through purchase of the shares, subscription of the shares, this part of the money is to be partly diverted for the working capital finance. And this equity shares, they does not demand any mortgage, they demand any interest, they does not any charge against the assets. Whatever, when there is a profits in the business, they will get the dividend, otherwise they have no charge against the profits or the business, against the business. So that is the best dependable source of finance. So likewise preference shares also used by the companies for the finance in the working capital, part of the working capital finance of the business. Preference shares are little bit having the preference again than the equity shareholders. because equity shareholders will get the dividend after the preference shareholders will get. So if there is no profit, that means loss, that both the equity shareholders or the preference shareholders cannot demand the dividends for their investment. So that is the very dependable sources of finance. Then the second one is your debentures. Debenture is a long-term debt issued by the companies. That is the acknowledgement of the debt issued by the business, and the people subscribing for the debentures are called debenture holders. Generally, the debentures is a type of loan, but it is collected from the public and gives the interest. The company declare the interest before issue of the debentures, and according to that fixed rate of interest, the debenture holders are getting the interest, which is a charge against profits, and they demand the mortgage of the assets of the business. That means they are right to get the interest from the profits or the from the business, and right to return of their money after a fixed period of time. This debentures is issued for a fixed periods. So that is the debentures. And third one is your that term loans or the long term loans. That is the loans taken or raised from the bank or financial institutions. Different financial institutions are there, or the different banks are there from which the long term loans are to be raised, and this is also to be payable at a particular rate of interest. Their principal as well as the interest are the obligations for the business to pay it. So this is also a fixed or the permanent sources of finance which are used in the business. Okay. So that is the permanent sources of working capital or the fixed sources of working capital. That is the external sources. And next come to the temporary or the working capital, which is 3/4 part of the working capital business. That means it is the major part of the working capital, which is generally financed by the current assets is financed from your current liabilities. That means the if the current liability is not sufficient to finance the current assets, then at the time permanent sources of working capital is used for the financing of the current assets. So that means that is the temporary part, so part of the working capitals or the variable part of the working capital. That is also having, this is also having two sources. This is also internal sources and external sources of finance. Internal sources are provision for depreciation, provision for taxation, unclaimed dividend, unclaimed dividend, then external sources are mostly that is creditors, then bills payable, then accrued expenses, for short term loans, then fifth part is bank credit, sixth is your public deposits. So these are the 6 external sources of temporary or variable source of working capital finance. That means, come to the first one, that is the internal sources of temporary or variable part of working capital. These are all both internal as well as external source constitutes your current liabilities, which finance directly to your current assets. So that is the most important or major sources finance, because it constitutes 80 to 75% of the working capitals. And the most important source, internal sources, is your provision for depreciation. Business makes the provision for the depreciation to replace the assets in future years. So in currently, when there is a need, that provision for depreciation kept in the business will be used for working capital finance. Then second source is your provision for taxation. That business also make the provision for to pay the tax against the profits every year, and that provision which are to be kept in the business out of the profits, that also can be used for the working capitals business in the business. So that is the when there is a need, that can be used. And third internal sources is your unclaimed dividend. Unclaimed dividend means that a dividend which is not claimed by the shareholders, it is remained in the business and it is not used, and those unclaimed dividend can be fully utilized for the financing of working capital in the business, for the working capital operations. So the business can use upon these 3 internal sources whenever it is required, but mostly the business use the external sources of working capital, temporary or variable sources of working capital finance, which constitutes your major part, which constitutes your current liabilities. That means all are current liabilities shown in the balance sheet. The first sources of working capital finance is, there is the creditors, because it is a most dependable sources of finance for the business. Every business purchase the goods from credit and payable after few months. That is the credit policy is to be adopted, and that credit policy helps to finance the current assets or the working capital operations in the business. Then the second second source of external sources of variable working capital finance is, that is the bills payable or the credit papers. That means the bills used, the bills of exchange which are used against the creditors to payable after few months or the few time, and that time will be helps for the working capital, arranging the working capital finance. That within that periods, that the business will infuse the working capitals from other sources, and that bills payable will be payable in time, and the creditors demand will be fulfilled. And the third one is your accrued expenses. That is also another important sources of external source of working capital. Accrued expenses means outstanding expenses, expenses which is already due but not paid, and the business paid it after few months or the after 1 month or after 15 days. So that 15 days after 1 month will be used those expenses for the arrangement of the working capital finance. And fourth one is your short term loans. Short term loans are the loans taken from the bank on the demand. That means for short periods less than 1 year, and this is to be arranged with the particular rate of interest, so that will be financed. And next is your the bank credit. So bank credit also another important sources of finance. These short term loans can be also part of the bank credit, one of the short term loans. Cash credit, short term loans, bank overdraft. These are the 3 sources, important sources of the finance to be get from the bank credit, in the form of bank credit, to finance the working capital. So bank credit gives your, that is the cash credit, short term loans, and the third one is your bank overdraft facilities. So these are the three important sources of bank credit finance will available for the working capital finance, and generally these are to be available on demand from the bank with a little bit of market rate of interest, and the bank provide it to the business on the basis of credit worthiness or financial strength of the business bank provided. And the last sources of finance is your public deposits, that is also important sources of variable sources working capital finance, that public deposits are to be deposits collected from the public in the form of different documents or the different papers, like in the form of debentures, and the people deposit the money which is at a higher rate of interest given by the bank. So public are interested to deposit money in the business. It is for certain period, means less than 1 year, and during that period the business use it. When there is an infusion of the funds or the cash into the business refund it within the time with the principal and interest. So these are the various sources of working capital finance. Okay, so that is the important sources of working capital finance. So now comes to the picture, when there is a shortage of working capital, again there is a shortage of working capital is arises, then what the business is doing. So you come to the picture of the balance sheet. If you see the balance sheet, this is your assets, this is your liabilities. Okay. So liabilities constitutes your shares, debentures and current liabilities. Your fixed assets, your current assets and fictitious assets. So this is the balance sheet. So in the balance sheet, if you study the balance sheet clearly, then generally there is the shares or general debentures are financed to the fixed assets, long term liabilities finance the long term assets, current liabilities finance to the current assets. Generally this is the practice for the each and every business. So here we have seen that in the working capital finance, that working capital, though the working capital is divided into two parts, permanent part of working capital and variable part of working capital. Permanent part of working capital constitutes only 20 to 25%, because it should be remain in the hand of the business to continue the business operations without any facing financial crisis or the financial problems or the difficulties by the business. And these permanent sources of working capital are generally financed, part of long term funds are generally financed to the current assets. So that is the permanent sources of working capital. And we had seen it, already discussed it, internal sources and external sources. Internal sources is your reserve surplus. Here is the reserves and surplus also is there, debentures and shares, and external sources are issued shares, debentures, etc. But temporary or the variable part of the working capital is generally financed by also internal sources, external sources, and this internal sources constitutes your provisions, all type of provisions, then current liabilities, all type of provisions. These two finance the current assets. All type of provisions are internal sources. There is unclaimed dividend, provision for taxation, that provision for depreciation, all those things. Internal sources, internal generation of funds kept in the business, which are to be used for the future, and when there is a requirement, that is to be used to finance the current working capitals. And these are the general sources or the normal sources, which are normal practice of the business, that to finance the current assets from the current liabilities. Basically, creditors, bills, payables, and accrued expenses, short-term loans from the public and others from the companies, and bank credit, that is cash credit, short-term loans, bank overdraft, public deposits. These are the various external sources of working capital. But still, the question arises When there is a shortage of finance, then what shortage of working capital finance, how we will do it? So this is called bridge financing. This is called bridge financing. Bridge financing is nothing but the fill up the gap, that gap between, that is the time of funds required, that is the time of infusion of funds is there, that is the shortage of working capital, and there is the cash or the infusion of the funds to the working capitals. That means bridge financing is the short term financing of the working capital sources of finance, which fills the gap between the shortage of working capital and the time when the infusion of the cash or the funds arises. So this is called bridge financing, and this bridge financing generally used by the business when there is a shortage of working capital finance either from the permanent sources or from the temporary sources. At that time, the company use the bridge financing for the working capital finance. So bridge financing constitutes your IPO, initial public offering finance. That means company immediately issue the shares through public offer and collect some cash or the funds to infuse into the working capital operations. Second is your debt financing. Debt financing means take the loans at the higher rate of interest on demand. And third one is your equity financing. That equity financing means issue of equity shares by the companies and to the shareholders to collect the money from the shareholders and use it for the working capital finance. So this is bridge financing. Even if there is a shortage of working capital finance is there, at the time company when I collect those money on request from the Reserve Bank of India with the some bonds or some papers, and this is RBI will provide them working capital finance. So these are about the working capital sources of finance, or the how working capital is to be financed by the business, and hope you will enjoy it and this will help for your higher studies or the research. Thanking you.